Hey there, it's Darius Faru. So there's one critical aspect of investing that most videos don't cover, and that is the importance of dealing with loss, right? I started investing in the stock market in 2007, and within a year I lost 60% of the money that I invested. And my response was like almost any other human. I just stopped investing altogether. And that's what happens to most people who start investing at the height of a bubble. They invest in something when everyone else does. And when everything comes crashing down, the pain of loss is so bad that they swear to never invest again. And most of us can't stand the thought of losing money, and me included, right? Because growing up, our family lived paycheck to paycheck, and we really struggled financially. So as I got older and I started earning my own money, I held on to it for dear life. And this is a problem if you're serious about investing, because honestly, I can't think of a single successful investor who did not lose money. In fact, most successful investors earn the majority of their wealth after their biggest losses. And this is a critical aspect of investing. You must be okay with losing. Otherwise, you will never take a risk with your money. And what is investing? It's all about taking risks. But if you want to stay in the game of investing, the key is to never lose big. When you invest, do everything you can to never lose more than 10% of the money you have in the market. You can always come back from that. And how can you make sure you don't lose big? Well, I have a rule for that, and I call it the 90-10 rule of investing. And it's based on the idea that most people are better off by putting their money in index funds. In fact, that's what Warren Buffett himself recommends to people who don't want to be full-time investors. And honestly, it's the best way to get market returns without any effort. But what if you want a little bit more upside? What if you're interested in the markets and want to take some risk but don't want to lose a lot of money? I'm like that as well. While I've been investing since 2007, my career is in writing and teaching. I enjoy my work and I don't want to be a full-time trader, but I still like to take a little bit of risk and potentially have higher upside. So that's basically speculation, right? And all the short-term successes you see about Bitcoin and trending stocks and currencies and commodities, all of that stuff, it's all speculation. You buy an asset and you hope to sell it at a higher price. There's honestly nothing wrong with that. And I know a lot of index fund enthusiasts are not a fan of speculation, but honestly, I personally don't mind it at all. I just don't want to put all my money on the line. So I created the 90-10 rule of investing, which states that you put 90% of the money you allocate to stock investing in an index fund, and you use 10% to speculate. So I take 90% of the money I want to invest in the market and put it in an index fund like the Vanguard S&P 500 ETF, and I use 10% to make a few bets on things I think will take off. But since I'm taking risks with a small percentage of the money that's meant for the stock market, I'm not taking a big hit if my riskier bets don't pay off. And if my bet pays off, I'll take the extra return. If it doesn't pay off, that's okay, because at least I won't get wiped out. And if I get a little bit less return, it's better than the 0% I get on my savings account. So I win either way, right? I hope you found this useful. If you did, feel free to share it with a friend or hit the like button. And finally, check out my free mini course called Wealth Strategies. In that course, I'll show you the strategies that I've used to become financially and emotionally independent. And you can get free access by following the link in the description. And like always, until the next video, take care.